Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, monster day today. Nvidia blew out earnings and it's all unicorns and rainbows. Or is it? We're going to show you a couple reasons why we're seeing what we're seeing and what we can expect to see as we progress through this year. Let's dive in.
Trade Genius.
Hey buddy, it's Bob with Trade Genius. Hey, it is holiday season and our holiday specials are running right now. Just promo code HOLIDAY. You already blew it. You missed the Black Friday specials, but this is your second chance to take advantage of some of the best pricing that we do for the year. Check us out, tradelikeagenius.com, tradegenius.co, tradegeniusacademy.com. All roads lead to Trade Genius. Check us out. Incredible deals. Thanks for listening.
So Bob, Nvidia unbelievably had a pretty strong earnings report. I was actually quite surprised that they beat as much as they did. And of course, yes, you know, estimates kind of get sandbagged, but even the estimates were huge. So, you know, obviously the market's rejoicing, but it's kind of interesting, this chart that you found that kind of explains a lot of what we're seeing. Cause I you know, you can hear the sentiments, I think, from people that watch the show that, you know, this is a big joke, you know, this stuff, these valuations don't make sense. And I mean, they really, you know, I have to agree with that. But like we always talk about, the market is not the economy, and the incentives in the market are much different. They're not aligned with a lot of what we would think is reality and what makes sense, because the institutions are in a position to make money, right? And where do you make money? Most of it you make to the long side. So they're going to milk the long side as long as possible. But this chart is interesting. I'm going to let you explain it, because I think if people can wrap their heads around this, then they'll have a better understanding of what we're seeing and why things can go higher.
Yeah, I mean, look, you know, the people that are driving the market dynamics right now are pretty clever. And what they've done is, you know, you don't see the market when you see SPY. You see a distortion field that is really looking at the largest companies in the S&P 500 that's really driving all the price action. And if you want to throw that chart up, you could see right here alone the weighting that I think is 61% of the market of the move is done by the top 10 stocks in the market, which is just insane. So, you know, I could say we're in a bull market and a bear market, and we're correct, because what's happening here is that there are stocks that haven't moved at all. I mean, 1% in 4 or 5 months that are perfectly good companies, cash flowing well, making money, and they're just being set on the shelf because all the action is in these stocks here. And it was really interesting, Phil. Too complicated just to throw charts up, but I'll try to explain it. You found a really interesting narrative that was being put forward by a trader on X, and he was explaining, as he was doing forensic accounting on Nvidia, but Nvidia is not the only one, is that they are buying back shares, but they're not settling the buyback, and that money is being used by another entity to buy out of the money calls. And the best way to think of that is that, you know, you ever watch Star Trek, you know, or Star Wars as a kid, and all of a sudden, you know, the tractor beam grabs the vehicle and pulls it in? Well, that's what this gamma is doing. So they're taking small amounts of cash and they're just driving these large, you know, moves in market capitalization, and then they're focusing on the top 10, 15 stocks and creating a distortion field around SPY to make it look like everything is awesome. And so far, you know, they haven't really been punished, and I can't even imagine the level of leverage that is being put together every day. And this works until it doesn't, and it can work in reverse. And that's the thing that really worries me the most, is that, because look, I don't manage my portfolio with the top 10 stocks, and I don't go to cash every night, and I'm not short the market, you know, so I don't want to wake up one day and have another 2011 flash crash on my hands and then wiping out 2 or 3 years worth of gains because of these clowns trying to just drive the last drop out of everything, Phil.
Right.
And speaking of the last drop, why don't you explain this chart? Amazing.
Yeah. So on one hand, we've got basically like a blow off move that I would say, as we were talking before we got on, that, you know, it's kind of similar to what we saw, where you have a trend through the 90s, latter half of the 90s, and then you have a blow off in tech that blows the entire market off. It's kind of similar here, where we have, you know, basically a move up really through most of the the 2010s to the 2020 era, right? And then like we're getting this blow off move, which can go higher. I mean, if things really get squeezy, you could see upwards of maybe 6,000 plus in the S&P 500. That's how crazy these things can go. Why? Because we have tons more M2, which is money supply in the system. We still haven't drained that out from COVID, and we have more leverage in the system than we did back in the dot-com bubble and the great financial crisis even. So, but that being said, similar to those eras, we have these leading indicators for recession. We've shown you guys personal interest income, our personal interest payments are at extreme levels that we've never seen before. The angle of attack on that is incredibly steep. Here we have real gross domestic income, or GDI. You hear of gross domestic product, which is our economic output. Well, you also have to look at GDI, which is gross domestic income. Real gross domestic income factors in inflation. And you guys can see here with basically 100% hit rate, whenever we get this dip below the zero line, so this is a year over year change, whenever we get to zero and negative, what do we have? We have these gray vertical bars. What are those? Those are all your recessions. So 100% chance, according to real GDI, that we enter into a recession in the back half of this year in all likelihood. So, and you're thinking, how is this possible when everyone's, the economic picture is slowing down and this and that? But again, like I said, you have a ton of money, you have a ton of dollars circulating in the financial system. You have more leverage than you've ever seen. And if you look on the charts, a lot of times you're going to get a pretty steep rally into a recession. That's pretty normal. And so if you add all that up, the most money in the system, the most leverage that we've ever seen in the system before a recession, then it shouldn't be a much surprise that we're seeing what we're seeing in the markets. And on top of that, you're seeing the highest concentration into stock names that we've ever seen, because you can take a look at something like a PayPal. And if this was the great financial crisis era, or if this was the dot-com bubble, even with PayPal, which has been knocked into the dirt because it's been missing earnings, but even if that was the case back then, that stock would not look like how it looks today. And the reason why that's the case is, again, because you are concentrated in these like Mag 7s. It's probably shrinking down to Mag 3 at this point. And that's not good, guys. That's basically like, we're hitting stall speed essentially, but stall speed can also extend the flight a few more miles. And so I think it's going to be pretty obvious when we have topping patterns, because you're going to see a sharp spike in what the market looks like, a sharp spike up followed by a sharp drop. And it's that lower high that doesn't quite get back to the highs, but everybody thinks we're getting back to the highs, is what tricks everybody. And slowly over the course of about 3, 4, 5 weeks, you look behind you and you go, we got a top in the market. And that's usually how these things start to play out as the market rolls over. And it rolls over because the underlying fundamentals cannot fuel this anymore. Because remember, if we're going up on leverage, sooner or later it implodes. It always does. There's never a history in a market where leverage, look at DeFi, right? Luna, crypto space, same thing. House of Cards implodes. Dot-com bubble, same thing. Great financial crisis, same thing. It was just you're layering and layering and layering until you can no longer. It's basically a form of a Ponzi scheme, really, because it's built on leverage upon leverage. So sooner or later that implodes. There's no underlying fundamental flows from 401ks and things like that because the economy's already rolled over, and then you have the catch down process. So for me, Bob, I think we're just in a strange environment. Retail's going to have a really tough time wrapping their heads around this, especially I think because you have a whole generation too that's never been through a drawdown now, right? You have millennials that really, they weren't doing anything during the great financial crisis other than, they were growing up. They weren't paying attention to the market. So you have a whole generation that does not know what it feels like to go through an 18-month recession. And I think it's going to be, for a lot of people, it's going to be really tough because we've been spoiled in the last few years.
Yeah, I mean, look, this is a market mirage. Remember, stock market now is just the realm of the top 10% of the population, and the bottom 90% are just hoping that they can make it to the end of the month. And that's what makes it insidious, because we live in both worlds. We trade, Phil, we have assets, but I have children that are trying to make it in the world, and when you have a meeting last night and says, hey, Dad, can we do a Costco run on your nickel? The kids are running tight, and of course you have to do it for your kids. They're working full time, making great money. It's just that they're just being eaten to death. And at some point when that gross domestic income goes negative, I don't care how great it is. I don't care how great AI is. You don't have money, you're not buying the stuff, and then it'll just implode. And the thing about AI, I'm telling you, probably in 2 years, we're going to be talking about AI is incredibly deflationary. And it's going to be deflationary in people's incomes. It may not be deflationary in buying food and putting gas in your car and paying your rent. But look, Phil and I yesterday playing around with the thumbnails. We just laughed. We said, I don't know if you want to be an artist or a painter, because we could create stuff that somebody would pay $1,500 for. We just created it on ChatGPT. Can you imagine all these things that are going to just come in here and make whatever your skill, it's going to make it worth less. And income's going to fall before prices of things you need are going to fall. And I think it's going to be pretty nasty, Phil.
Totally agree. So guys, let us know your thoughts on today's podcast below, and your comments. We really appreciate them when you post them. But yeah, let us know your thoughts on what you think on how this market is behaving. Have you seen it before? Have you lived through the previous pump and dumps? Would love to hear that information from you guys. Otherwise, check out our stuff over at Trade Genius. If you're interested in navigating these markets, we've been through this before. We can help you navigate what's coming. And I think you guys will benefit from that, especially being in the room with other traders as well. It's nice to have a group think environment. All right, guys, thanks for watching. Please hit like and subscribe. Thank you, Bob. See you guys on the next episode. Take care.
Trade Genius.